We will jump into our next presentation here. We have Ipower, it's ticker IPW, and we have the CFO and COO joining us, Kevin Vassily. How are you, sir?
I'm good. Thanks, Brent. Good afternoon. Yeah, good afternoon, everyone. Thanks for joining me today. My name is Kevin Vassily. Don't worry about getting it wrong, Brent. That's fine.
Vassily. Did I say it right that time? Kevin Vassily.
Perfect.
Got it.
I'm the CFO COO of Ipower. Delighted to be here to share our story with you. Given our limited time window, I'm going to jump right in here. So Ipower was founded 10 years ago by two software engineers, and the company is now one of the leading online retailers and suppliers of hydroponics equipment in the U.S. We ship to all 50 states and Canada, and have just started our market entry into Europe. Approximately 90% of our business is online, where we serve the home gardener grower market as well as the small commercial cultivator market. And I think we're unique in focusing on these two niches. We've created a data and analytics centered culture at Ipower. We'll cover this in a little bit more detail later in the presentation, but we leverage data in all aspects of our business thanks to the tech roots of our two founders. And we feel this is unique in the hydroponics industry. We've got roughly 29,000 SKUs in our product catalog, giving our customers everything that they would need to start and operate a growing project. Notably, over 4,000 of these SKUs come from our proprietary in-house brands, and those SKUs now make up approximately 70% of our revenue, which is a major differentiator for us against the peer group that we're most often comped against. We've built up relationships with over 100 suppliers, both in the US and Asia, that go back over 10 years. And these relationships allowed us to thrive despite all the supply chain volatility in the last 18 months. We also have a very sophisticated fulfillment and inventory management capability given our size. Our current supply chain, logistics, and fulfillment infrastructure, we think, can support sales volumes 10 times the current levels that we have with very little incremental investment. And then one last summary comment I want to make as we start here is that I think this will be a little bit more clear as we go through the presentation, but I like to think of us as a product development, merchandising, and e-commerce company whose current product portfolio is centered on the high-growth hydroponics industry. We feel we've laid the foundation and have the necessary capabilities that allow us to extend our reach into adjacent product categories and drive incremental growth. So a little bit about our financials. Our fiscal 2021, which ended in June, was a strong year for Ipower, with revenues growing 35% from fiscal 2020 levels, gross margins increasing by 430 basis points to 42.2%, and non-GAAP net income increasing 47% year over year. Our top line growth was a function of having a product catalog with a compelling value prop, sufficient availability of product coming out of the pandemic, thanks to our robust supply chain, as well as favorable tailwinds from further e-commerce adoption during the pandemic. Our gross profit growth was driven in large part by a greater mix of our in-house proprietary products as a percentage of total sales. Prior to the pandemic, our in-house products made up less than 50% of our sales and now make up around 70%. Gross margins for our in-house products average around 45%. So just a little bit about our product lineup. We carry over 400 third-party brands and two in-house brands, Ipower and Simple Deluxe. And just this morning, we announced our third in-house brand, Flourish, which covers the nutrient category. Our top-selling categories in fiscal 2021 are shown here, with ventilation being our largest category. I'll note here that our second largest category, is nutrients. And that was the only category where we did not have any proprietary in-house products during fiscal 2021. However, we did spend the last 9 months developing an in-house nutrient line. It's an important category for us to be in, and I'll cover that reasons behind that for a little bit later, but we're really pleased to have been able to announce that this morning. We have multiple digital channels and partners, including Amazon, Walmart, and eBay. These are all strong relationships for us, but we have a particularly strong relationship with Amazon. We also see further opportunities with some of the new e-commerce marketplaces that are currently being built out, as well as traditional retailers in the home and garden space, and have begun receiving some of our initial purchase orders from our channel partners for sales into Europe. We also have a proprietary in-house channel called zenhydro.com, and that provides direct sales to consumers as well as small commercial cultivators. It's important for us here, I think, to talk about our customer segments we serve, as we think it does make us unique in this space. First segment that we cover is the residential gardener home grower segment. This is our largest segment and one that's not really well served by others in the market. The second segment is the small commercial cultivator segment, which remains a meaningful part of the commercial market, but is often ignored by competitors focusing on mid to large size cultivators. While we largely service this segment right now through our offline channel, we believe that this segment can be effectively served by an e-commerce solution sometime in the future. Right now, the majority of our products are likely used for cannabis production, but we see meaningful opportunity in adjacent categories such as vertical farming, indoor/countertop horticulture, as well as traditional lawn and garden. With our e-commerce capabilities and supplier network, we think we can move into these adjacent categories relatively easily. So on the left-hand side of this page, you'll see a typical starter setup for the home growing, kind of average home growing kind of project. Initial setup can range anywhere from $800 to $2,000, depending on the overall size of the operation and the brand of equipment that you would choose. One of the main reasons we think this market is an attractive one is that a number of the products involved are consumable in nature, some of which are displayed on the right side of this page. These include replacement light bulbs, filters, and of course nutrients, with nutrients being the category with the highest turnover and probably the healthiest margins. For obvious reasons, getting our in-house nutrient brand into the market was a high priority for us. So our in-house brands have been one of the major catalysts for our recent growth, with much faster than third-party brand, growing much faster than the third-party brands we carry. We've got roughly 1,200 SKUs that were added to our catalog so far in 2021, and we expect these SKUs to contribute to our growth in 2022. Gross margins for our proprietary catalog average approximately 45%, which is well above our third-party product margins, and give us a corporate gross margin well above industry peers. In-house products should continue to grow as a percentage of sales and help us to expand our margins in the future. And the in-house nutrient brand we just announced today will be an important part of that margin story for us over the next several years. We also have some new products under development that'll incorporate what we're calling smart functionality. So think of it as connected, operational functionality for otherwise kind of unconnected products, as well as sensor technology that we hope to have in the market by the end of our fiscal year, which ends in June 2022. Well, we've got a number of other channel partners, that are working on developing several more. It makes sense to highlight, Amazon here, I think, because it's a critical relationship for us. We started working with Amazon in 2011 as a 3P seller, and we're invited onto Amazon's first-party marketplace. It's also known as their vendor platform in 2013 by invitation. We now do most of our business with Amazon's vendor platform. So you should think about it in terms of as a wholesale relationship with Amazon. So through our work on this platform, we've developed a really systematic, data-driven approach to product development and merchandising. We've built our own data harvesting tools, along with some off-the-shelf tools that are commercially available to collect information on a whole host of product attributes and run that data through our demand models before introducing products to market. We also carefully craft our listings, around product images, videos, what titles look like, bullets, etc., So they're all, both compelling for kind of the human eye, but are also search engine optimized. And we think the results, speak for themselves. We have very, very strong customer reviews on this platform, over 60 Amazon Choice products, and a number of best-selling SKUs. We think we've optimized this channel really well, over the many years of work we've put into it, and it shows in our results. Our revenues with Amazon grew over 50% in fiscal 2021. I touched on a little earlier the importance of technology and analytics, but I want to spend just a little bit more time explaining what it means to the organization in a couple of areas and why it's really important for our growth. First, in product development, we've built tools, and I think I mentioned this earlier, that harvest data on category and SKU level product attributes in the marketplace, both from public and private sources that we subscribe to. These attributes include sales volumes, pricing, product features, customer reviews, both negative and positive. We use this data to help us narrow in on new SKU opportunities that we believe can generate both sufficient volumes for us, but also sufficient margins to warrant go forward decision on a product launch. Historically, this approach is given us about a hit rate of 90% on these product launches. We say that in some ways out of necessity. We were a self-funded company prior to our IPO. With growth capital that we currently have now, we feel like we can take a little bit more risk by focusing on some higher potential return categories that we couldn't do in the past. We've also used that data that we collect in conjunction with the custom ERP system that we developed in-house to effectively manage our inventory, both on mature SKUs as well as newly introduced SKUs. One example of this in the last or in the 12 months prior to our IPO, we were able to turn our inventory over 6 times with less than 1% of the inventory considered slow moving. We could have not pulled that off without the tech and data foundation that we built. So where do we grow from here? We believe we've got multiple paths to pursue incremental growth over the next 3 to 5 years, given the foundation that we've laid. These opportunities include growing both our channel footprint, both here in North America, but also in Europe, growing our in-house brand footprint through our in-house development engine, pursuing strategic acquisitions of product lines and brands that are currently not in our in-house catalog, as well as looking at potential expansion of our commercial business, expanding into adjacent categories where we can leverage our e-commerce footprint and development expertise. And then finally, by continuing to enhance our product development through growing our engineering team and analytics team with the goal of bringing new products to market more rapidly. So I will stop here. That's the bulk of my prepared remarks. Thank everyone for your interest in Ipower, and I'm happy to answer any questions that you might have from the audience in the time we have remaining.
Sure, Kevin. Thank you very much. So just jumping on the heels of something that you just said right there. So what would the expansion in your commercial business look like?
So it would largely be twofold. It would be to focus on the small commercial cultivator market. So if you think about commercial cultivators, a distribution with the attribute being size, we still think the bulk of the operators in the U.S. are in that kind of small niche. And we don't think they're serviced well by the big wholesalers or big quasi-retail / distribution centers. And so, given our e-commerce focus, we're pretty convinced that the best and most efficient way to service those cultivators would be through an e-commerce platform. So it would really be expanding in that front.
Cool. Thanks for answering that. And then one more question I wanted to ask you here. I like that you highlighted, in-house brands are about 12% of your SKUs, but accounted for about 70% of sales. So kind of two aspects of the question here. How do you leverage that? Or do you have plans to, work toward stuff that isn't under your umbrella directly?
Yes. Yeah, of course. Part of the reason we carry third-party brands is that, we also want to be considered a one-stop shop for people that are coming directly. But, I think what we've shown that we can do over the last, 4 to 5 years is narrow in on categories where there is, real margin opportunity as well as growth opportunity, and you bring a product to market that, I think fits the needs of the segments that we serve. So there will be kind of multiple categories, and I think I mentioned a couple where we're developing some both incremental changes and new product categories for us. One of them is the sensor technology. Think of it as environmental sensor. We can test humidity in a grow environment. We can test pH in a nutrient environment. So those type of things. There's not great product in the market for consumers right now, and we think by going in those categories, we'll continue to grow that in-house mix of products that we sell.
Sure, got it. Okay, thanks a ton for joining us today, Kevin. Kevin Vassily, CFO and COO at Ipower. The website is on the screen right now. It's ir.meetipower.com. It's ticker IPW. Thanks a ton for joining us again.
Thank you, Brett.